Hello, good morning, everybody, and welcome to today's presentation on 1031 Exchange Basics. My name is Jeff Stechmann. I'm the Eastern Regional Manager for Asset Exchange Company. Before we kind of get started, I just want to kind of let everybody know today how we're going to handle today's presentation. Don't feel like you have to write every single thing down. Today's presentation is actually being recorded, and you'll receive a link to today's recording if you want to refer back to any of the topics that we're going to talk about today. And some of the various topics that we're going to cover, I actually have in PDF form, just like single page PDFs. I'm going to email those out to everybody that's on the line today, because I find a lot of times if you're a realtor, especially if you have a client that has a 1031 exchange need, you really would love to be able to send them something. And the email with the attachments that I'm going to send out to everybody, it'll be in a format that you can forward on to clients, or if you're an investor yourself, to refer back to the topics at a future date. And then as far as questions go, I'll open the floor up to questions at the very end of the presentation, because I find a lot of times if you do have a question, most often it'll be answered in an upcoming slide. But again, if it's not, at the end is when we'll open the floor up to questions. On the right-hand side, there's a box that says questions. Right there is where you'd want to type your questions in. So again, my name is Jeff Stechmann, Eastern Regional Manager, Asset Exchange Company. Kind of give you a little bit of background about myself. I've actually been in the business for 26 years. I did a lot on the title side of the business to get my start. I'm originally from New Orleans, so if you hear the accent come through, please forgive me. Every now and then it rears its ugly head, but actually, I'm based out of Tampa, Florida, and I've lived in Florida for 23 out of those 26 years. And as long as I've been doing this, I've seen the really good times in the real estate industry, and boy, I've seen the really bad times too. And hopefully we never have to experience those bad times again. And right now the real estate industry is just booming. The entire country is it's really a great market right now. And hopefully we can keep up this pace at least until the end of the year. But let me give you a little bit information about the company. So again, we're Asset Exchange Company, and we've actually been in business since 2006. And over the course of our existence, we've done about 40,000 1031 exchanges. It's all that we do. We don't provide any type of closing services. We don't provide any type of financial services. In the industry, we're known as a qualified intermediary, QI for short. Now, some other terms you may hear people refer to is an accommodator. Another common term is a facilitator, or just simply an intermediary. But most often, people refer to as just simply as QIs. Our main job in a 1031 exchange is we actually hold the proceeds from what we refer to as the relinquished property. So that's the property that's being sold in a 1031 exchange, and we hold those proceeds on behalf of the seller, or the exchanger, because they can never actually have receipt of the funds. If they do, they would lose their ability to do a 1031 exchange. And we're going to talk about that, in more details in the next few minutes in some upcoming slides. But now, a word of caution about QIs. It's amazing in today's heavily regulated real estate industry that, at least on a federal level, there actually is no federal agency that oversees what we do. So, what does that mean for everybody? Well, what that means is anybody out there can be a QI. All right, there's no type of requirements you have to have any type of E&O insurance. There's no type of requirements you have to have any type of bond. There's no guidelines on where you hold the proceeds or the type of funds you hold the proceeds in. It's a really scary, scary thought when you sit down and think about it. So, if anybody on the line today is currently involved with the 1031 exchange, please just make sure you've done your due diligence and you're dealing with a reputable company. All right. The great news when you deal with us is, we're actually based out of California. Our home office is in San Francisco. And because we're California based, well, the state of California actually has a state agency referred to as the California Franchise Tax Board. Now, that Franchise Tax Board actually oversees qualified intermediaries in the state of California. They do require us to carry minimums for the E&O insurance we have, minimums for the bond that we carry. We're subject to audit by that Franchise Tax Board. There's guidelines on the financial institutions where we hold the proceeds, the type of funds we hold the proceeds in. That's all overseen by that Franchise Tax Board, which is great for anybody that deals with us in California, right? But anything that we do, any exchanges that we do in any other states, because we do business throughout the entire United States. Well, that Franchise Tax Board has oversight in any file that we work on. Because as I mentioned, they can come into our office at a moment's notice and audit any of the files we work on, not just California property, but anything that we do. So, you do have some assurances when you deal with us. And as far as our ownership goes, well, we're actually owned by two gentlemen. Now, they've been in the business for, 20-something years, one of which is actually a tax attorney. Now, his name is Adam Skarsgård, and Adam is actually considered like a 1031 exchange expert. He's been called upon to testify in tax court as an expert witness on 1031 exchange. He even occasionally teaches at UC Berkeley on real estate and tax law, that type of thing. The whole reason I like to bring his name up is because, one of the things that we do that I don't know if any other QI in the business offers is any of the exchanges that we're involved with, if for some reason they were to get audited by the IRS, we would actually provide free audit support. We'd work hand in hand with the client's CPA, helping to defend the audit, and it primarily would be done by our tax attorney owner, Adam Skarsgård. So you do have some other assurances to dealing with us as well. Now, let's talk a little bit about the history of exchanging. So, believe it or not, exchanging has been around for close to 100 years. And it really started back in the 20s with farmers. And, back in those days, it was pretty simple the way exchanges were done. Maybe I had a farm that I grew corn, and I knew another farmer that he had a farm that he grew wheat. Well, I wanted his farm, and he wanted my farm. So all we did is just swap farms. And it was really that simple back in those days. But, our modern day exchanges, kind of the format that we follow today, well, that was really started back in 1979. And there was a gentleman by the name of T.J. Starker. Now, Mr. Starker lived in California, and he owned all this land in California with timber on it. And what Mr. Starker did was he sold that land to a timber company called Crown Zellback. And what Crown Zellback did is, in exchange for the land, they actually gave him what was referred to as exchange credits. And what Mr. Starker did is, over the course of the next few years, he went out and bought various properties with those exchange credits. And that's really kind of how our modern day exchanges started back in 1979 with T.J. Starker. So, if anybody on the line today has ever heard of the term a Starker exchange, that's where it comes from. It comes from T.J. Starker's last name. I talked to some CPAs that, they've been in the business for, 40, 50 years. They still refer to a 1031 exchange as a Starker exchange, right? So again, you may hear that term pop up every now and then, but that's where it comes from. It comes from T.J. Starker's last name. Now, when we talk about 1031 tax-deferred exchange, that name is actually derived from Internal Revenue Code Section 1031, right? And the code states this: no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment, if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or for investment. Now, I know that's kind of a mouthful, right? Well, where the code states that property held for productive use in a trade or business. So you can do a 1031 exchange on any type of real property that you use in your trade or business. Okay, I'll give you guys an example of maybe how that could work. Well, we did an exchange for a gentleman that owned a daycare center, right? So he was using that real property for his business, right? So he sold it in a 1031 exchange, and the replacement that property that he purchased was another daycare center. Because why? Because he was going to use that real property for his business. All right. So any type of real property that you use in your trade or business, you can sell it in a 1031 exchange, and you can replace it with any other type of real property that you use in your trade or business. Right. Now, the next part of the code where it states for investment. So for investment, that could be something as simple as, let's say you own a single family residential home, right? You hold that property for investment. Well, how do you hold it for investment? Well, it's a rental property, right? You can take that rental property, you can sell that rental property in a 1031 exchange, and then what can you buy as your replacement? Well, that's the next part of the code, like-kind property. So what exactly is like-kind property? Well, like-kind property is any type of real property that you use in your trade or business or that you hold for investment, right? You can sell that in a 1031 exchange, and you can replace it with any other type of like-kind property, which is any type of real property that you use in your trade or business or that you hold for investment. All right. So just because you own that single family residential home, right? You hold that for investment, that rental property, right? You can sell that in a 1031 exchange, and you can replace it with another single family if you want, but you don't have to, okay? You could replace it even with a condo, a townhome, a vacant land, a duplex, a fourplex, a commercial strip shopping center, a commercial warehouse. You could purchase it. You could replace it with a downtown commercial office building in any state in the United States, okay? Any type of real property that you use in your trade or business or that you hold for investment, you can sell that in a 1031 exchange, and you can replace it with any other type of real property that you use in your trade or business or that you hold for investment. All right. It doesn't matter if it's residential or commercial to residential. Everything is intermingled. All right. Even property that you use in your trade or business. Maybe you want to sell your business. The guy that I mentioned to y'all with the daycare center. I have another lady. She wants to get out of the daycare business, okay? So she wants to sell her business, that the real property that she's using in her trade or business for the daycare center. She wants to sell that, and she wants to buy replacement investment property. She wants to buy condos on the beach, okay? She can do that, right? Because everything is intermingled, right? But it's only the real property associated with, if it's a business, only the real property is what you can exchange, not the entire business itself, just the real property associated with it. Okay, and the properties can be located anywhere in the United States, including Guam, the U.S. Virgin Islands, or the Mariana Islands. All right. Property in Puerto Rico is excluded from that number. I get that question sometimes. I believe the reason property in Puerto Rico is excluded from 1031 exchange is because I think Puerto Rico is under a different tax structure than we are here in the States, and that's why property in Puerto Rico is excluded from 1031 exchange. Okay? If anybody on the line has ever heard of the term a like-kind exchange, that's where it comes from. All right? It comes from that part of the code that talks about like-kind property. All right? Now, what are current tax rates? Well, typically when you sell real property, if you have any gain in the property, all right, you're going to be subject to capital gains taxes. Now, capital gains tax right now is either 15% or 20%. All right, the 15% historically, it was applied if you were single and you had income of less than $400,000 a year, or if you were married and you had income of less than $450,000 a year. That's where you're at the 15% capital gains tax rate. Now, the 20% capital gains tax rate historically was applied if you were single and you had income of greater than $400,000 a year, or married with income of greater than $450,000 a year. That's where you're at the 20% capital gains tax rate. The reason I say historic is because the income levels have risen just a bit in the last tax reform bill that passed a few years ago. But any way you look at it, you're still going to be looking at either 15 or 20% capital gains tax rate. All right. On top of that, you also would be subject to what they refer to as depreciation recapture tax. All right. That's an additional 25% tax. Now, you may be asking yourself, what does that mean? Well, how does that work? Well, the depreciation recapture tax works like this. Any depreciation that you've claimed in the property for the lifetime that you've owned it, okay, when you go to sell that property, they're going to hit you with a 25% tax the depreciation recapture tax, for the entire amount that you've claimed for the lifetime that you've owned the property. All right. On top of that, you also may be subject to what they refer to as the Medicare tax, right? That's an additional 3.8% tax. Now, how does that work? What's that about, right? Well, the Medicare tax, that was something that they passed back in 2010 with the Affordable Care Act, Obamacare. It actually went into effect in 2013. It was one of the things that they passed to offset some of the costs of the Affordable Care Act, right? The good news is when you do a 1031 exchange, you can defer having to pay any of these taxes, right? Now, what am I not listing up on the slide? Well, I'm not listing anything to do with state income taxes, all right? So for those on the line today that are located in Florida like me, or in states that don't have state income taxes, well, we don't need to worry about that, right? But if we live in a state, or even if we're selling property that is located in a state, and if that state has state income taxes, we would also be subject to state income taxes. The good news, again, is when you do a 1031 exchange, you can also avoid having to pay those state income taxes. Now, every state kind of has their own way of you completing some type of form or going through some type of process in order to get out of having to pay those state income taxes. I'll give you guys a couple of examples. We did an exchange for a gentleman. Now, he was a Florida resident, okay, but he had an investment property located in California. Now, California has state income taxes, all right? Now, he was doing a 1031 exchange with us, all right? So the good news for him is because he was doing a 1031 exchange, he could actually get out of having to pay those state income taxes for the state of California. Even though he was a Florida resident, it didn't matter to California. They still wanted their state income taxes, all right? But again, when you do a 1031 exchange in California, you can get out of having to pay those state income taxes. Now, what they made him do is that he had to complete the state of California form. He had to follow with the state, and that's how he got out of having to pay those state income taxes. Now, it's my understanding he's got to complete that form every year thereafter. The year he doesn't complete the form, they come after him for the taxes. All right. Now, we did another exchange for, it was a lady, she was another Florida resident. She was selling property in Maryland, I believe it was Maryland, and Maryland has state income taxes. Now, again, she was doing a 1031 exchange with us, and what the state of Maryland made her do to get out of having to pay those state income taxes, she had to complete this state of Maryland form. I think we even had to sign off on it, and she had to submit that to the state. I think it was like 21 days prior to her closing. All right, so again, every state kind of has their own way of you completing some type of form or going through some type of process in order to get out of having to pay those state income taxes, right? For those of you all on the line today that are realtors, y'all think about this for a minute, right? If that's your client, all right, if your client is sitting there, if you know they're selling an investment property, right, and they're not talking about doing a 1031 exchange, it's a perfect opportunity for you to bring it up, right? Because they'd be looking at all the federal taxes, what I have on the slide, and especially if they live in a state or they're selling property that's located in a state that has state income taxes, it's even more beneficial to them, right? Because they're going to be able to save on those state income taxes. And if you, as their realtor, if you bring that to the table, if you open their eyes to it, all right, the idea of doing a 1031 exchange, it's going to be win-win for everybody. You're going to win as a realtor because, hey, you look great to the client. The client's going to win because, hey, they're going to save on all the taxes. And if they can save on the taxes, right, it's just going to give them that much more buying power to go out there and buy a better property. And guess what? If they can buy a better property, hopefully it's going to be a higher dollar property with higher income coming in every month for them. And for you as a realtor, hopefully you just increase your commissions all by recommending a 1031 exchange. All right. So some things to think about for everybody. If you're an individual investor, another thing, using that leverage of doing a 1031 exchange to let you buy a better property, higher income property, higher dollar producing, income producing property for you. Okay. Now, I get this question pretty often. People will ask me, they say, well, Jeff, how long do I need to hold on to a property for it to be considered an investment? Well, and, the honest answer is I don't know, because there's nowhere in the code that states how long you need to own a property for it to be considered an investment. All right, the code just states you need to use the property in your trade or business, or you have to hold it for investment. All right, now, if you ask some CPAs, they'll tell you a good rule of thumb is hold on to the property for at least a year or 12 months. All right, and one of the reasonings behind that, if you just think about the logic behind it, let's just say you buy an investment property today, right? Well, you're going to claim that property, and you're going to hold it for a year, right, for 12 months. So you're going to claim that property as an investment property on your 2021 taxes, right? Right. Any income that's coming in from rents, any expenses that are going out, you're going to claim that on your 2021 taxes. You're also going to claim any of that income or any of those expenses on your 2022 taxes, right? Because you're holding it for a year, for 12 months. Well, over 2 tax filing years, you're going to be showing to the IRS, you're going to be reporting that on 2 different tax returns that property is an investment property. Is that a good rule of thumb? Well, the answer is maybe, okay? Some other CPAs will tell you, well, really a good rule of thumb is to hold onto the property for at least 2 years, all right? Now, one of the reasons behind that is back in 2008, the IRS came out with guidelines regarding vacation homes, right? And in those guidelines for vacation homes, the IRS stated for a vacation home to be considered an investment property, you must own that property for a minimum of 2 years or 24 months, right? So some CPAs pick up on that and they say, well, for vacation homes, the IRS is giving us guidelines stating for that vacation home to be considered an investment property, you must own it for at least 2 years or 24 months. Therefore, any type of investment property, a good rule of thumb is to hold on to it for at least 2 years or 24 months, right? But the reality of the whole thing is it's not so much about how long you own the property, it's more so about your intent, right? And your intent could be something like this. Did you advertise the property for rent? Did you advertise it for fair market value rent? If fair market value rent is, let's say, $1,500 a month, and you're advertising it for $5,000 a month, you know what? The IRS is probably going to have an issue with that, okay? If you get audited, and the IRS comes in and says, prove to us you held that property for investment, you're going to have to be able to back it up, all right? Now, I list one particular court case on the slide. It's referred to as Resnick versus the commissioner, all right? In that particular court case, the circumstances was you had a husband and wife, right? They owned a single-family residential home. That was their primary home. They also owned another single-family residential home that was an investment property, a rental property, all right? So what they did is they sold the rental property in a 1031 exchange, and then the replacement property that they purchased, well, in their case, they purchased another single-family residential home that was going to be the new investment property, okay? Now, during the 6-month period after they did their 1031 exchange, okay, they actually ran a classified ad in the town newspaper that they lived in, advertising the property for rent at fair market value. They even showed it to 2 potential renters during that 6-month period, but for whatever reason, they could never get the property rented out. Right now, what else happened during that 6-month period is one of them loses their job. All right, so they had a mortgage on their primary home. They also had a mortgage on the investment property. But what? The investment property wasn't rented out, right? So after 8 months of ownership, they wound up selling their primary home and they moved into the investment property. All right, in that particular court case, it was ruled that their intent for that investment property was to hold it as an investment. But what happened? The circumstances changed, right? And they were forced to do something. Okay, so again, it's not so much about how long you own the property, it's more so about your intent. And again, I'll say it again, if you get audited, you're going to have to be able to back it up. All right, so everybody remember that, investment intent, okay? Now, vacation homes. I always like to talk about vacation homes, especially for me. I live in Florida. Here in Florida, it seems like everybody has a vacation home or everybody wants a vacation home. So how does that vacation home qualify as an investment property? All right, so this is actually referred to as Revenue Procedure 2008-16. All right, and the first guideline I've already given you guys. You must own the property for a minimum of 2 years or 24 months, right? Now, for every 12-month period of ownership, okay, you must rent the property out for a minimum of 14 days at fair market value. All right. Now you can use it for some personal use. Okay. For every 12-month period of ownership, you can actually use the property for 14 days personal use, or 10% of the total time that you had it rented during that 12-month period. So let's say during the 12-month period, you actually rented the property out for 200 days, right? So 10% of 200 would be what? Would be 20, right? So you could use it for 20 days personal use instead of the 14, right? If that property meets those guidelines, it qualifies as an investment property, and you can use it in a 1031 exchange, right? Now, if it doesn't meet those guidelines, I wouldn't necessarily say it would be disqualified, right? In that particular situation, I would recommend to the client, I'd say, look, talk to your CPA, right? And if you and your CPA can come to an agreement where you feel like you can justify that property as being an investment property, then hey, by all means, use it in a 1031 exchange, all right? We're always going to recommend to people, talk to your CPA. Because why? Because your CPA is going to have way more information about your tax situation than I ever would, that I would even ever care to know, right? If the CPA comes back and says, yeah, I don't think we'd have a problem. I think we could justify it as being an investment property. You know what? We move forward with it. Use it in a 1031 exchange, all right? I mentioned in the very beginning, everybody, some of the topics we're going to talk about today I have in various PDFs. This is one of them, right? So I'm going to email those out to everybody that's on the line today. I have, various topics, but one of them is going to be about vacation homes, all right? So be on the lookout. All right, so the 1031 exchange guidelines, right? We're going to talk about property qualifications. We're going to talk about the tax referral requirements, all right? There's some timelines everybody needs to be aware of, right? There's also something that's referred to as the identification rules that I want everybody to be aware of. All right, so let's recap. What type of property can you do a 1031 exchange on? Again, any type of real property that you use in your trade or business or that you hold for investment, all right? You can sell that in a 1031 exchange, and you can replace it with any other type of like kind property, which is what? Any type of real property that you use in your trade or business or that you hold for investment, right? So again, it doesn't matter if it's residential or commercial to residential. All of that is interchangeable, okay? And where can those properties be located? Anywhere in the United States, including Guam, the U.S. Virgin Islands, or the Mariana Islands, all right? Again, property in Puerto Rico is not included in that number, all right? Now, what type of property is excluded from 1031 exchange? Well, your primary residence, your primary home is excluded from 1031 exchanges, right? You cannot do a 1031 exchange on your primary home, all right? For your primary, you may qualify for what they refer to as a Section 121, all right? And just briefly, the way it works is you had to live in the property as your primary 2 out of the last 5 years, all right? If it qualifies, when you go to sell the property, if you're single, all right, if you have any gain, and you're single, the first $250,000 of any gain is tax exempt, and if you're married, the first $500,000 of any gain is tax exempt. All right, that's what you do for your primary. You don't need anybody like me to help you with the 121. That's just something you claim on your tax return in the year that you sell your primary home. All right, but primary residences are excluded from 1031 exchange. All right, now, property held for sale is also excluded from 1031 exchange. I'll give you guys an example of maybe the way that could work. Here in Florida, we have a lot of these national home builders like Pulte Homes, Lennar Homes, KB Homes, okay? Let's say I'm Pulte Homes, right? Now, Pulte, they're one of the largest single-family residential home builders in the entire country, right? They build newly constructed properties in multiple states, right? When those properties are completed, what do they do with them? Well, they turn around and sell them, right? Because they're holding those properties for sale and they're not holding them for investment, they cannot do 1031 exchanges on those types of properties because it's property held for sale, all right? So property held for sale is excluded from 1031 exchange, right? Dealer property is excluded from 1031 exchange. Now, give you all an example of what dealer property could be. Let's say I'm a flipper. It's somebody that, let's say I buy a property, I don't know, 2 or 3 months goes by, I fix it up during those 2 or 3 months, and then when it's completed, what do I do with it? Well, I turn around and sell it as well. Well, I can't do 1031 exchanges on those types of properties either because that's like my business. That's my inventory. Um, you know, I can't. I fix properties up, and when they're completed, I turn around and sell them. Well, I can't do 1031 exchanges on those types of properties, okay? Because that's considered dealer property. Now, here's a possible solution for somebody that's a flipper, okay? Let's say they buy a property, right? I don't know, again, it takes them maybe 2 or 3 months to fix it up. And then when it's completed, instead of turning around and selling it, they go to their realtor and they say, hey, can you put this in the MLS system showing it for rent? Now let's make sure we put it in there for fair market value rent as well. That's a little different, right? Because now all of a sudden I'm showing my intent that I'm holding that property for investment and not for sale. Hey, who knows? Maybe I even show it to a potential renter at some point. I run some type of credit report on that potential renter. I don't know. Maybe they have horrible credit, and I decide not even to rent the property to that potential renter. All right. All of that type of stuff is going to be their proof to the IRS. All right, that's going to show that their intent is to hold it for investment. It's going to be their trail of breadcrumbs, right, to prove that they held that property for investment and not for sale. Okay, if they ever get audited and the IRS comes in and says prove to us, well, they could say, look, here's the day I sent an email, or here's the email I sent to my realtor requesting them to put it into the MLS system for fair market value rent. Here's the MLS listing showing it for fair market value rent. Here's the day I showed it to that potential renter. Here's the credit check I ran on the potential renter. Again, that's going to be their backup, their proof to show that they held that property, or their intent was to hold it for investment and not for sale. But again, if they buy a property, all right, and however long it takes for them to fix it up, and when it's finished, if they turn around and sell it, you can't do a 1031 exchange on those types of properties. All right, you got to be able to show that your intent was to hold it for investment and not for sale. All right, if that flipper gets audited, they're going to have to be able to show that. Now, foreign property is also excluded from 1031 exchange. All right, now this might be pretty obvious, but let's say I couldn't sell an investment property located here in Florida in a 1031 exchange and then try to buy replacement property, I don't know, somewhere in Canada or Mexico or maybe even Europe. Okay, it has to be what? It has to be property located in the United States, including Guam, the U.S. Virgin Islands, or the Mariana Islands. All right, so foreign property is excluded from 1031 exchange. All right, now, guideline number 2, the tax deferral requirements. All right, so in order to defer your taxes 100%, okay, rule number 1 is you must reinvest all of the net proceeds in property of equal or greater value. Now, what are the net proceeds, right? Well, the net proceeds, that's the cash, right? That's the cash that normally you would get out of the closing. Now, we're the qualified intermediary, right, the QI. We're going to hold those proceeds on behalf of the seller, the exchanger, okay, because the rule is they can never have receipt of those funds. If they do, they would lose their ability to do a 1031 exchange, right? So they can't close today and then call me tomorrow and say, hey, Jeff, I want to do a 1031 exchange. At that point, it's too late, okay? Because once they have receipt of the funds, that's it. They've lost their ability to do a 1031 exchange, right? They couldn't even close today, walk out the door, get in their car, and call me from the parking lot and say, hey, Jeff, I want to do a 1031 exchange, right? Because their funds may be sitting in that attorney's escrow account or the escrow company or the title company's escrow account. That company may be waiting to wire the funds out to the client, all right, the seller. In that particular situation, they have what's referred to constructive receipt, right? They have a legal right to the funds. Guess what? They've lost their ability to do a 1031 exchange, right? So we have to get involved prior to the closing, basically prior to them walking out the door, all right? So we're going to hold the proceeds, the entire amount from the closing on this sale, all right? The relinquished property, we refer to that as a relinquished property. They have to take that entire amount, all right, and they have to use that entire amount to purchase a replacement property, or it can even be multiple properties where the purchase price, or if it's multiple properties, the combined purchase prices are either equal to or greater than whatever the sales price was on the property that they sold. Okay, that's rule number 1. Rule number 2 is you must acquire an equal amount or greater debt in the purchase of any replacement property or properties, right? Now, that rule can actually have an exception. If you have cash that you can add to the purchase of the replacement property, you can offset that debt. Now, what is the debt amount, right? That's a mortgage, right? If you have a mortgage that you're paying off, all right, on the property that you're selling, the relinquished property, right, you're required to get a mortgage of at least that amount or greater when you purchase your replacement property or properties, right? Again, if you don't want to get a mortgage, no problem. If you have cash, that's the exception. If you have cash that you can add to the purchase of your replacement property, you can offset any debt requirement or any additional debt. Or you could even do a combination of cash and the lower amount of debt, a mortgage, all right, a lower amount. All right. Obviously, if you have no debt, if you don't have a loan that you're paying off on the property that you're selling, a mortgage, then you're not required to obtain a mortgage in the replacement property or properties. But you do have the option. Okay, if you need to or you want to get a loan to help you purchase the replacement properties, you always have that option. Okay, now, guideline number 3, there's some timelines everybody needs to be aware of. All right, so from when you sell your relinquished property, you're going to have 180 calendar days to purchase any replacement property or properties, right? And that's calendar days, right? That's holidays, that's weekends. Okay, last week was June 1st. That's the start of hurricane season, right? So from June 1st to November 30th is hurricane season. Hey, if you're getting hit with a hurricane and everything around you is shutting down for a day or two or a week, whatever it may be, none of that matters. Okay, the clock is always going to be ticking. All right, so it's 180 calendar days to purchase your replacement property or properties, and the clock starts ticking once you sell your relinquished property. All right, so if you sell your property today, day 1 is tomorrow. All right, now the first 45 days of the 180 days is referred to as the identification period, right? And what that means is you must identify any potential property or properties that you want to purchase, right? Now, they don't have to be under contract. You just have to identify any potential property or properties that you want to purchase. That's something else that we're going to assist with, all right? We're going to provide to the client, the exchanger, a form. It's called the Identification ID letter, all right? And on that form, there's going to be some blank lines, right? And it's going to have to be specific to a property address or addresses, right? The client's going to have to fill that out, sign off on it, get it back to us by midnight of the 45th day. That's how they will formally identify their replacement properties. They do it to us, the qualified intermediary. Okay, again, they don't have to be under contract. You just have to identify whatever potential properties you want to buy. But here's the thing about the 45 days. Let's just say you find the perfect property and it's day 46. Okay, at that point, it's too late. All right, so whatever you put on that form, you're going to have to make sure you're going to be able to purchase at least one of those properties by day 180. All right. If for some reason you're unable to purchase any of those properties that you put on that form by midnight of the 45th day, unfortunately, you're going to be paying all your taxes, right? If you're purchasing one of them, purchasing the property on day 181, you're paying all your taxes, right? If you don't identify any properties by midnight of the 45th day, you're going to be paying all your taxes, right? There is no exceptions after midnight of the 45th day. You can't go back and say, well, hey, that property just sold, or there was a hurricane, it got destroyed in a hurricane, or there was a forest fire, it just burned down to the ground. None of that matters, all right? You have to go with what you put on that form by midnight of the 45th day. All right, there's no exceptions. If you're unable to purchase any of those properties, unfortunately, you're going to be paying all your taxes. All right. Now, there's some rules to identifying. All right. There's 3 different rules. All right. Now, I'm going to read each one of the rules to you. And if you don't quite understand them, don't worry about it. All right. Because I'm going to walk y'all through the numbers give y'all some examples of how the numbers work for each one of the rules. And then hopefully once I show you how the numbers work, it'll all make sense for you. All right. Now, the most popular rule that we see investors enacting is the first rule. All right. It's referred to as the 3-property rule. All right. Now, the 3-property rule states that you can identify up to 3 properties without regard to the fair market value of those 3 properties. Now, you may be asking yourself, well, what is fair market value? Well, fair market value, that's the purchase prices, okay? So if you identify 3 properties or less, okay, the purchase prices of any of those properties can be any dollar amount, all right? It does not matter as long as you identify 3 properties or less, okay? Now, if you want to identify more than 3 properties, you can do that as well, right? But it's actually going to put you into this next rule. It's referred to as the 200% rule, right? And the 200% rule states this. You can identify over 3 properties, but you cannot exceed 200% or 2 times the combined fair market value of the property being sold. So what exactly does that mean? Well, what that means is if you identify more than 3 properties, okay, the combined purchase prices of all those properties cannot exceed 200% or 2 times whatever the sales price was on the property that you sold, the relinquished property. All right. Now, if you want to exceed the 3 property rule and you also want to exceed the 200% rule, you can do that as well. But it's going to put you into this next rule. It's referred to as the 95% rule. Now, the 95% rule, very rarely do we even see investors using this rule, okay? It doesn't make a lot of sense the way it's written, all right? But remember, everybody, this is the IRS, and sometimes this stuff just does not make sense, all right? Because it reads like this. You can identify over 3 properties and exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you identified. Now, I know that's probably about as clear as mud, all right? Let me show you all the examples, all right, especially with the 95% rule. And hopefully, once I show you the examples of the example of how the 95% rule works, it'll click for you. All right, now here we go. All right, so here's a 3 property rule. Again, if you identify 3 properties or less, the purchase prices can be any dollar amount, all right? It does not matter. All right, so here we go. All right, so we sell for $1 million. Now, in this example, we're going to go out, we're going to identify 3 properties, all right? Because we've identified 3 properties, we're in the 3 property rule. Now, let's keep the math simple. Let's say we're going to be buying each one of them for $1 million each, all right? So we've identified how much in property? $3 million worth of property, right? Now, we could be buying each one of those properties for $10 million a piece, right, for a total of $30 million in identification. Again, it doesn't matter. As long as it's 3 properties or less, the purchase prices can be any dollar amount, right? It does not matter. But what matters, and I'll say it again, all right, if you identify 3 properties, okay, you better make sure you're going to be able to purchase at least one of those properties, all right? So, what's the best way to lock up a property? Is to put one of them under contract, right? Now, you're not required as far as identification goes, but, especially the market that we have going on right now where properties in some cases are selling the day they're listed, okay, well, the best way to lock up one of those properties, if that's going to be one of the ones the property that you want to purchase, is to put it under contract, all right? So in practice, what we see investors doing is they will put a property under contract. That's one of the properties they identify, and then maybe they'll identify 2 other properties just as backup, all right? Because after midnight of the 45th day, if something happens to that contract that they have a property under, if the whole thing falls apart, at least they'd have the opportunity to purchase those 2 other properties they would have identified on the form by midnight of the 45th day, all right? So that's the 3 property rule. Now, here's the 200% rule. Again, this is where you exceed the 3 property rule, but then you cannot exceed 200% or 2 times the combined fair market value of the property being sold. All right, so here's how it works. Again, we sell for $1 million. Now, this time we go out and we identify 5 properties, all right, because we've identified 5. What just happened? We exceeded our 3 property rule, right? So that puts us into the 200% rule. So what does that mean? What that means is the combined purchase prices of all 5 of those properties cannot exceed $2 million. Now, you may be asking yourself, where's he getting the $2 million from? Okay, here's how it works. We sold for $1 million, right? So 200% of the $1 million sales price, or 2 times that $1 million sales price, is how much? $2 million, all right? So that's where I'm getting it from. I think this one is pretty straightforward, okay? Now, what if you want to exceed the 3-property rule? You also want to exceed the 200% rule, right? You can do that, but it's going to put you into this next rule. It's referred to as the 95% rule. And the 95% rule states that you must acquire at least 95% of the value of all the properties that you've identified. So here's how it works. Again, we sell for $1 million. Now, in this example, we actually go out and we identify 10 properties, all right? Because we've identified 10, what just happened? We exceeded our 3-property rule, right? Now, let's keep the math simple on this one as well. Let's say we're going to be buying each one of those properties for $1 million each, right? So how much have we identified in property? $10 million worth of property. Because we've identified $10 million worth of property, guess what? We exceeded our 200% rule, right? Because that was how much? $2 million. All right, so in our example, if we only purchase 9 out of the 10 properties, that's only going to be 90% or $9 million. That's not 95%, right? If we do that, if we only acquire 9 out of the 10 properties, guess what happens, guys? We blow our entire exchange and we have to pay all of the taxes, all right? So the 95% rule, the reality of the way it really works is really 100%, all right? Whatever you identify, you're going to have to buy, all right? And we're using really simple numbers here, right? We're saying, hey, everything's going to be an even $1 million. You know what? Those purchase prices, they're going to be all over the map, right? It's going to be really hard to sit down and try to figure out and say, okay, let's see, if I get this one property, wait, that's only going to put me at 93%. All right, maybe I need to make sure I purchase this other property. Wait, that may only put me at 94%. The 95% rule is really 100% of whatever you identify, you're going to have to purchase. All right. The IRS wants to limit you in how many properties you can identify. They don't want you going out there and identifying everything under the sun. All right. Because you know what's going to happen? If you identify everything under the sun, you're going to have to buy everything under the sun because of this crazy 95% rule. All right. Again, we don't really see investors enacting it that much, but I just want to make sure everybody knows it does exist. All right. Now, how does the whole closing process work with 1031 exchange? Well, we really don't start doing our thing until there's a contract that gets signed on the property being sold, the relinquished property, all right? Because the way the whole process starts is I need to get a copy of that contract, all right? I'm also going to need to find out the contact information for the person that's handling the closing. Also, obviously, I'll need to get the seller's contact information, all right? But once I get the closing information, the closer, the company that's handling it, we're going to reach out to that company, and what we're going to get from them is a copy of the title commitment. All right, and once we have the title commitment, and it's also referred to as the title search. Some parts of the country call it the title binder. They just call it title, but it's the search of the title. All right, once we have that in hand along with the contract, then what happens on our end is we prepare what we refer to as an exchange agreement. Right, and those are going to be documents that are basically going to set the exchange up. Right, we're going to email those over to whoever's going to be handling the closing. They're going to be sitting there waiting for the closing to happen. All right, day of closing, they're going to be signed by the seller. Okay, and basically what happens in that transaction is we're going to step into the shoes of that seller. Right, and that's going to give us the ability for whoever's going to be doing the closing, they're going to wire those net proceeds from that sale, and we're going to hold them. All right, they're going to wire them over to us. We're going to hold the entire net proceeds on behalf of that seller, the exchanger. All right, that's it. That's that transaction. The sale takes place of the relinquished property. Once that transaction takes place, then that clock starts ticking, right? 180 days to close, right? The first 45 days is the identification period. We're going to be sending out the identification ID letter. The client's going to be filling it out, getting it back to us by midnight of the 45th day. Now, once they get a contract on their replacement property, okay, we'll need to get a copy of that as well. All right, we also are going to need to get the contact information for whoever is going to be handling that closing, right? Because think about it, we're going to be holding all the proceeds from the sale. We're going to need a contact person who's handling their closing. We're going to need to get that company's wiring instructions, all that type of stuff. We're going to prepare some other documents that are going to be signed by the buyer at the purchase of the replacement property, right? Because in that transaction, we're going to step into the shoes of the buyer. All right, and that's going to give us the ability to take the proceeds that we've been holding on their behalf from their sale, and we're going to wire those proceeds over to whoever's going to be doing the closing to help them purchase that replacement property. All right, that's it. That's the entire closing process. It's not that complicated of a process when it comes to the closings, right? Just everything leading up to it is the complicated stuff. Figuring out what you want to purchase, by midnight of the 45th day, identification, negotiating the contracts. Do you need to get a loan? Do you need to add cash? All that's the complicated stuff. But the actual closing process itself is the easier part of 1031 exchange. All right. Now, what do we charge? What's our fees, right? Well, everything that we've talked about today, all right, is referred to as a delayed exchange, right? That's the most common type of exchange, right? That's where you sell first. You sell your relinquished property first, all right? And then you buy your replacement property last, right? You're buying your replacement property by day 180, right? So that's you sell first, you buy last. Our fee to do those types of exchanges is delayed exchange, which is the most common type. Probably 90 to 95% of all the exchanges that we do, we charge a flat fee of $12.50, right? We don't collect anything until it physically closes, all right? I just walked y'all through the process of how the closing process works. If we prepare all the documents, right, everything's sitting at that title company, escrow company, attorney's office, waiting for the closing to happen. If for some reason the contract falls apart, if it never gets to closing, okay, we don't charge any kind of cancellation fees. We don't charge any type of wiring fees, anything like that, all right? For those of you all that are realtors on the line, right, you don't earn your commission until the property closes. Well, we don't earn our fee until it physically closes either, all right? So we charge $12.50 at the closing of the sale, and what that covers is the sale of one property and the purchase of up to 3 replacement properties, okay? So the client can sell one, and if they want to buy up to 3 properties, that's our fee. It's a flat $12.50. If for some reason they want to buy a 4th property, it's an additional $250 for any property that's purchased after 3. All right. Now, there's a few other type of exchanges. We don't have time to talk about them today. I do have another class coming up on the 24th of this month. It's Thursday the 24th. It's an advanced 1031 exchange strategies class. That's going to be from 11 to 12:15 Eastern time. In that class, we're going to talk about this next type of exchange. It's referred to as a reverse exchange, right? The reverse exchange works just the opposite of a delayed exchange. It's where you buy first, where you buy your replacement property first, and then you sell your relinquished property last, right? They can be significantly more complicated than a delayed exchange, okay? Those start off at about $6,500, right? There's another type of exchange referred to as a construction exchange. Another term you'll hear people refer to it as is an improvement exchange or a built-to-suit exchange. Again, in that advanced class, we're going to talk about that, all right? Those can be significantly more complicated, all right? It's when you sell your relinquished property, you find a replacement property, but it's not everything that you want. You want to do some improvements to it before you actually purchase it. All right, there's a thing called the construction improvement built-to-suit exchange. Those start off at about $6,500 as well. All right, I mentioned to you guys in the very beginning, one of the owners of our company is a tax attorney. He personally handles any reverse or construction improvement built-to-suit exchanges because they can be so complex. All right, he looks at it, each one of them individually, bases our fee on how much work they're going to be, but he personally handles any of those types of exchanges. All right, that's it. We are done with the presentation. I'll go ahead and open the floor up to questions. All right, there's a box on your right-hand side. If you want to type some questions in, just feel free. And while we're waiting for the questions to come in, I'll remind everybody again. So today's presentation was recorded. Okay, you're going to receive a link in the next few days with a link to today's recording if you want to refer back to any of the topics that we talked about. And also, I mentioned this in the beginning, here and there, I mentioned it during the presentation. Some of the topics that we talked about, I have just in single-page PDFs. I'm going to email those out to everybody. All right. I also have some of my literature I have in Spanish and I also have in Chinese. If you want those additional languages, please let me know. All right. Also, don't feel like you have to be a 1031 exchange expert. All right, if you have clients that have 1031 exchange needs or questions, hey, I'd love to talk to them. All right, if you're an individual investor yourself and you have questions, let me know. All right, I want to be a resource for you guys. Contact information's up on the screen. All right, you can call me, you can send me an email. I want to be here for you. If you have any questions, please let me know. The email that I'm going to send out to everybody. What some realtors will do, they'll take that email. They may pick and choose the PDFs that they want to forward on to their client, but they'll forward that on to their client. Sometimes they even CC me on the email, introducing me to their client, and then, hey, I can take it and run with it at that point. All right. So again, don't feel like you have to be a 1031 exchange expert. This class, it's a basics class. We didn't have time to go into the various types of exchanges. Again, I have a class coming up on the 24th. It's a Thursday. It's from 11 to 12:15 Eastern Time. If y'all want to attend that class, we're going to talk about the other types of exchanges. We're going to talk about how to calculate the taxes. We're going to talk about some other things, entities in 1031 exchanges, LLCs, tenants in common. We're going to calculate some of the numbers associated with the closings of different ways you can hold money back. It's referred to as boot. We didn't talk about any of that today. We just, today is a limited class. For Florida realtors, I do have a 2-hour continuing ed class that I teach as well. That's going to be on the 30th. Now, anybody can attend it, but it's kind of a combination of this class and the advanced class and even more, all right? If you have an individual real estate office and you think the other agents in your office would benefit from one of my classes, the basics, the advanced, or the 2-hour class, let me know. All right, I do a lot of individual class presentations for classes, real estate offices, boards of realtors, title companies, attorneys, CPAs. Let me know. We can set up a webinar with them, with your individual office. If you want the information about the various classes, let me know. I have a PDF that has all of the various classes with descriptions and that type of stuff, my bio, if you need to forward it on to a manager or the owner. All right, I'm available. All right, well, folks, it doesn't look like we have any questions coming in. So, hopefully I learned a little something today. And, if you do have a question after we hang up, again, feel free, shoot me an email, give me a call. I know sometimes it's hard to type in a question in 20 seconds, especially if it's complicated. So, hey, I'm here. Just let me know. I'd be glad to talk to you. But we'll go ahead and wrap it up for today. We're a few minutes short of 12 o'clock. But I appreciate everybody joining today. And, hopefully we'll talk soon. And everybody, please stay safe, stay healthy, and have a great weekend. It's Thursday, and we're just about there. So please let me know if I could do anything for you in the future. Thanks for attending today. Bye-bye.